I'm Matt Bouchard with NAREIT, and I'm at EPRA's annual conference in London. Joining me is Bart Gysens, Head of Property Research with Morgan Stanley. Bart, how would you describe investor sentiment right now regarding the European listed real estate market?
Well, I think it's very mixed, it's very varied. I think there was a very positive consensual view out there until very recently, and I think the events of August have really changed that. I think buy-side consensus has really deteriorated rapidly. I think sell-side consensus is still relatively bullish, and I think depending on the speed of typing, people are gradually adjusting their views. We yesterday, Morgan Stanley, we adjusted our views down. We became a bit more bearish. We think that property values are probably going to experience a bit of a wobble over the next 6 to 12 months, that NAVs are probably going to fall a bit, and that as a result of that, property stocks will probably won't do very well, particularly in the UK. And I think it's something that gradually is people coming to that realization. But I think sell-side consensus will gradually turn more negative over the next couple of months.
And what impact does inflation have on that outlook?
Well, I think inflation is very, very important. It's probably more crucial to the performance of property as an asset class and property shares which offer a play on that asset class. And I think we've seen many examples of the past how when there is a change in an inflection point in the trajectory of inflation, that real money investors, endowments, pension funds, insurance companies, charities, they adjust their allocation to real estate. Typically they go from nominal to real when inflation picks up, and they go from real to nominal when inflation falls. And I think the recent increase in inflation expectations has meant that a lot of pension funds have increased their allocation to real return asset classes, including property. Now, I think the economic slowdown that we're in now means that probably a lot of these pension funds are less in a hurry to buy, which could be one of the factors that means that property values are going to take a bit of a breather.
And are there any areas or regions you expect to outperform over the next year?
Well, I think UK property, the UK is a lot more volatile, a lot more liquid. You've got a lot more pricing data, and therefore there is a more true mark-to-market. I think Germany is probably the other extreme where there is more ostrich-like behavior, where we don't have many transactional data points, and therefore property values don't change very much. I think the UK has outperformed strongly over the last 12 months because we had those transaction points. A lot of foreign money came in because sterling is cheap, the UK is liquid, you can actually deploy a lot of capital, and you can actually deploy your capital in size. You didn't really have that in continental Europe. So therefore I think the UK is probably going to underperform now on a tactical horizon because that's probably going to be affected by the slowdown a bit more.
Mm-hmm. And there's been a lot of talk at this event about Germany. What do you think needs to be done to unlock the country's investment potential?
Well, I think it's very difficult. I think there's too many vested interests in Germany. There are too many banks that also offer all kinds of fund products. I think there's not really a concept of mark-to-market, so the valuers are willing to be very accommodating to all these owners and show that values don't change very much. And I think to a lot of investors, they're very attracted by this low volatility. I think one thing that could be a trigger for that investment potential, as you say, to be unlocked is the fact that a lot of these open-ended funds, they are in a 2-year closed period, but their units are nevertheless trading on secondary exchanges at a significant discount. And what we saw in the Netherlands, for instance, with Rodamco and a couple of others open-ended funds in Australia, is that when they needed to open, effectively they couldn't open because people were buying shares at a discount and redeeming them. And that actually forced some of these open-ended funds to close indefinitely. That could be a trigger, but like I said, I think it's going to take a very long process. I'm not super bullish on Germany becoming the next UK or France anytime soon. I think we're gradually getting there, but and I think it would be in all of our interest that it would happen very soon, but don't count on it for the next 12 months, I would say.
Great. Bart, thank you very much for joining us. Great. For more news and analysis regarding the global real estate market, be sure to visit REIT.com as well as EPRA.com.